Well, it certainly feels like a Monday. So I guess we're on track. Good morning, everybody. We're going to get a lot of data this week, and we're going to get some guidance from a lot of the Mag 7. We've seen before where the S&P as a whole, say 85 to 90 out of 100 names in the S&P have a negative earnings or are expected to report collectively down about 3%. And that's what we've got on deck right now. It's going to be a pretty poor earnings across the board. But in the past, we've seen this situation where the Magnificent Seven are carrying the market. If you go and Google, the Mag 7 carrying the market, I think even that phrase would bring us back 1 or 2 years where those 5 to 7 names did all the heavy lifting. And the rest of the market, if you were looking at a unweighed S&P through, what is it, RSP or RPS, that market symbol that you can use for the unweighted S&P, everything else would down, all things considered. So in a negative market like this, if the Mag 7 perform well and can carry the load, we can actually rally and continue to rise. Otherwise, if they drop the ball and can't hold the market, the rest of the market's earnings are so poorly projected that we're inevitably going to continue this fade to the downside. Now we're getting a lot of data today out of Europe. So after 11:30, whatever the market influence was from Europe is going to end. That's something that we can use this afternoon. I know a lot of people like trading the market open. I think that's just a trap, really, but it draws eyeballs. So if you're maybe a little patient, you wait for the afternoon. No guarantees, of course, but we could see a reasonably decent afternoon once we're done with whatever data we're going to get out of Europe. Except we still have tomorrow. And I really expect the market to go into a sort of hurry up and wait mode. If you've heard me say that before, it's the idea that we're going to likely go sideways into a data point, whether it's an FOMC event, CPI, non-farm payrolls, whatever. It's where the market just collectively waits it out. And we sell into strength, buy into weakness. We just hold the range, playing a megaphone pattern while we wait on data. We never know it's going to be that way. We just kind of use past events and extrapolate forward what we think it'll be like this time. But first, we have to get through this data from Europe. So we'll focus on that. Looking at what's going on around the world, Japan down almost 7%. It's getting to be almost consistent in its negativity, and the numbers just keep getting worse and worse, worse. All of April, we've been seeing this every day. It was around 1.5 a day, and then it was 2 to 2.5 a day. We were getting into the -3s and 3.5. Now we're all a lot closer to 7% in a day. Can you imagine the S&P or the NASDAQ down 7% in a day? Oh, it's happened. If you were trading around COVID, you felt it, you played it. So it's not outside the realm of possibilities. That's deep enough to trigger lock limits in different markets. So if that was the S&P or one of our futures markets, it would be close to triggering lock limits at that point. Can't stress enough, keep your eye on Japan. Any news article that you can find from FX markets that talk more about what's going on in Japan so that you understand what the market is doing over there, understand the threat and the risk and contagion, which is a really big deal. If what's happening in Japan, like a domino effect, starts to break things around the world, things can get really ugly really fast. Beyond that, Hong Kong's basically flat. That'd be our China ADRs, BABA, Baidu, JD, PDD, EDU, maybe a little NEO, XPEV, that sort of stuff. Basically flat there. Hurry up and wait for Europe. Still getting data out of that this morning. Then we get into US markets. The Dow up a half, S&P also, small caps closer to 3/4. Same with the NASDAQ. Interesting that small caps and the NASDAQ both are up the most this morning, whereas your blue chip and your kind of just general broad sector, including financials, are up, but not up more than small caps. And tech is up, but the Dow blue chips not up as much. So we could dig around in that, or I would advise you to dig around in that. If you're a day trader and you don't trade the futures, you're trading equities. Look at the disparity here and see what in the Dow is holding us back. Very likely it's, like healthcare, semis. I'm betting healthcare. Not enough to keep us down. It's just holding it back more than others. And if it turns the corner and get that rising tide, then that's what we want to focus on. We've got additional auctions today. They are way up in the front. So while I don't want to say that they don't matter, they're not going to be as impactful, like a 10 or a 30, 20. Still, we always pay particular attention to the auctions if we have any, meaning if we see some at 11:30 or we see them at 11 or 1 o'clock, we just assume that there's going to be auctions on the other time frames as well. It's very rare to find just an 11:30 auction without also having an 11 o'clock and a 1 o'clock auction. Just because it's not listed here doesn't mean it doesn't exist. Later tonight, we're going to get data out of Japan. We just talked about how they're down almost 7% this morning. This data very likely is important. You want to pay attention to it, especially if you're swing trading. If you think you want to, grab these S&P, NASDAQ positions off the lows, it's got a nice low risk entry for a rally up. Keep in mind, we've got data coming tonight, and then we've got data tomorrow in that hurry up and wait scenario. PMI, it's kind of a big deal, and it won't be in the pre-market tomorrow. It'll be in the regular trading hours. And we got the 2-year, 1 o'clock tomorrow. So we can see here on the right side, Lockheed Martin, Tesla, Boeing, Facebook, Google, Intel, Microsoft. These are big names that are going to report this week. And the European influence today, European Central Bank and Bank of England, just keep in mind that the time that you see here is not correct for the Eastern market, right? This is my time zone. So you want to look at Finance Juice and see your time zone. If you're looking at this, it's just add an hour. So if it says 10:30, it's really 11:30. For me, I don't know what your time zone is. So after 11:30, not only will the EU market be closed, but we'll be done with European Central Bank and Bank of England speakers. We don't have any more after 11:30, which again lines us up really nice for an afternoon where we can get some trading done. The only thing that could throw a wrench in that is a hurry up and wait scenario. I had to log off a Thinkorswim. I was getting an error and forgot to log this thing back in. While we're waiting on that. For the S&P, we are really close to another structural level, that 49.46. And if that breaks, there is a gap to fill. 49.11 cog line. Then we got a multiple layer gap below that. My squeeze indicator kept crashing the platform. Goofy thing. All right, we have an MDP has a missed daily pivot. Markets hit their pivot statistically about 80% of the time. So the fact that we have not hit this pivot means we're in the 20 percentile. We're doing something that we wouldn't normally do. We're closer to the upper ADR than the lower ADR, which implies we're likely to go up and hit that. It's 50.45. There's a cog line at 50.32, 31-ish. We're there, just above it. We're still inside day. We now have a gap underneath us. To close that gap, we're going to have to hit that pivot point. It's a really big day that we've got to deal with and a very large week. So before we dig too much into that, let's just come out to the weekly, get some key levels here. So 50.88 is the halfback for the entire week. We'll take that. And then we've also got Friday to deal with. Which is basically the cog line, 50.11. We're under the 10, the 20, and the 50-day, and the 10 is under the 50. If we get the 20 under the 50, it's not good for technical analysis and the health of the market. We've kind of crossed the halfway point between the 50 period and the 200 period moving average. And once you cross the halfway point, you're getting into more of a predestiny, right? Like Tina, there is no alternative. It's almost self-fulfilling that we're going to go down and hit the 200 if you get too close to it, right? Or you kind of go past the midpoint. Now, there's nothing to really snap onto here. So just kind of eyeball it. Try to look at where the midpoint is. We dipped underneath it and came back up through it. Now, we didn't have to draw that generic line there. We have a round number right underneath our level, 5,000. We really need to hold that. I think trying to arbitrarily draw the line and find the midpoint is fine, is okay, but being this close to 5,000 anyways, between that midpoint, is better just to use that. We need to keep above this. So we went below it last week. We got back up above it. In this, at this point, that's going to be the one shot we get. Right? We come back down below it again. It's hard to believe that we're going to hold this low, build a base here, and rally back up without coming down to get that 200. It's possible. We never want to say the price can't do something, but the likelihood of going to 200 increases significantly if we close back below this 5,000 level again. So if we get below Friday's low, it's a really nice short down to 48.50. Just checking to see if they came out with the founder's note for today yet. Last week, they were late every day. They were late. Frustrating. So we've got two halfbacks to deal with, as we usually do. We're already above one. That's Friday's halfback. Now we've got the entire week's halfback at 50.88 that we want to keep our eye on. It's really close to the 10. And as the week goes on, the 10 is going to get closer to that line, and then it's going to cut underneath it. There is so much resistance overhead that even if the Mag 7 does want to carry the entire market, it's still going to be one heck of a fight to bring this back up again. And I'm not saying that we're looking at, a bear market scenario all over again. That's not really in the cards. But chopping about, even cutting down into 4,800 and just having a hard time rallying back up and then continuing higher, that is absolutely doable. Just keep in mind, we got QRA right around the corner and FOMC too. That's May 1. All it's got to do is hold the line into May 1. And then what, right? It's not like we're going to get all the answers there. Take it back to the weekly for a minute. We're holding that 20. As much as we possibly can, we're holding that 20. Now, we don't ever want to look at moving averages like they are supporting the market or anything like that. They do make a defined line in the sand, right? Decisions can be made above and below, and expectations can be drawn from how price reacts at, near, and around those levels. We need to keep it. We dipped underneath it, got back up there. We need to keep this. If we lose it, especially if we happen to pull up a little higher first, say into 5,100, right around in there, that halfback level would be a really nice pullback before continuing lower. That'll reinforce the idea that we can make it to 48. Yeah, I mean, out of the money, it shouldn't cost that much. And lottery tickets being lottery tickets, if I can put some edge into a lottery ticket to where there's actually more than a 1 in a million shot and it's not too expensive, why not, right? You could even decide to finance that out of the money put with a short call, right? I like to trade options on the futures just because of the lower margin. If you wanted to do a short call on the SPX, you need a very large account. And if you want to do a short call on SPY, you again need a very large count. But if you wanted a short call on the MES, you can do that with less than a $10,000 account. And if you do it on the ES, I think you can do it for with an account less than what, 20,000. The buying power and margin requirements to trade options on the futures is much, much less. So say you sell a call, we'll just choose that 5,100, nice round number. 15,000 in buying power. 15,000 is awesome. That is crazy small for a naked short call. Sell a call, buy a put, Bob's your uncle. The entire market is teetering on the edge of a flash crash. And as what generally happens with a flash crash is we drop down really fast, and by the end of the week, we're already back where we were and possibly even higher, right? It's not like we're going to continue lower, but that flash crash risk is real. And why not grab some cheap calls, right? I mean, yeah, why not? But I wouldn't buy the expensive puts. I said calls, but I wouldn't buy the expensive ones. Because right now, we don't have the next leg down. We bounced here. And so everybody's trying to figure out, are we going to bounce and hold and build a base? Or is this just a bounce up before we continue and roll over and go down? There's no amount of technical analysis in the world that's going to answer that at this point. We just know it's A or B. So you don't want to buy a put at the money, in the money, spending some serious money on a coin toss of 50-50, maybe we bounce. But an out of the money one, especially if you can find and finance it with a short call, heck yeah. The volume this morning is sitting at 100 again. Really liking this elevated volume structure, especially for this time of year. And it's going to, we would anticipate that it's going to fade, right? We start getting into the summer months. The volume typically fades out a little bit. The ADR tends to drop down a little bit. We're just not seeing that. It's really nice to see these numbers in the 100s down here. We are quite a ways from the put wall, and the call wall, zero gamma are considerable distance overhead. So unlikely that we're going to interfere with any of those option levels. The weekly pivot point is higher than yesterday or Friday. So we would have to do an inside day breakout before we could even get to the weekly pivot point. And remember, it's bias, whether we're above the pivot or below the pivot. And right now we're still below the weekly pivot. So we would still be looking at a bullish bias. That always confuses newer traders when we've got price going to the upside and they're told we're supposed to be bearish because we're underneath the weekly pivot point. Think of it like this. If you were to get a bearish setup when you're underneath the weekly pivot, then you would want to try to play that bearish pivot. But when you have price trying to come back to that weekly pivot, then you got to play what you have. And take this example from Friday to kind of do the same thing. We were underneath a daily pivot at that point. And when we're underneath the pivot, we would be looking for bearish plays. It didn't offer any bearish plays, so we didn't trade any bearish plays. That's how you put that round hole in that square peg, right? There is no setup for it. Speaking of missed daily pivots, that was also a missed daily pivot, but it's being scratched by the fact that we're above the daily pivot when on Friday we were below it. If it was going to be a continuation, we would have opened underneath the daily pivot this morning or last night. It is crowded. Yeah. So there's this concept about, like don't bet on black, right? Don't bet on red. Don't bet against Apple. There's all these phrases and concepts where kind of a little bit of a myth and then a little bit of a warning. Don't bet against the markets is something that I've held on to for a long time. And it doesn't mean it always works, but if we're in a 50-50 scenario and it's inches away from the market having a crash and burn, it seems like 8 out of 10 times somebody pulls its bacon out of the fire. There's some miraculous bit of news and the market latches onto that, and we skirt the edges of disaster and rally back into new highs. And it's usually where all those doomsayers on YouTube are coming out of the woodwork screaming about how this is it, we're finally going to break and it's all going down, and then it doesn't. 8 out of 10 times it doesn't. We just hold the line and we rally back out again. Yep. So, should you prepare? I mean, yeah, if somebody tells me a hurricane's coming, I want to make sure I got hurricane insurance. But I wouldn't load the boat expecting this magnificent next leg lower and put a lot of money on the line for a significant bearish market reaction. It's certainly possible, but more often than not, they pull it around. We are still underneath the 3-week and the 10-day. We're basically underneath everything except this 20-week. Last week I talked about person's pivots, and I got a little bit of feedback on that. Seemed to really kind of light people up. This is a man named John Person, and he built these 3 indicators. They're kind of supposed to work as a group, and it's not unusual. There's a number of group indicators on Thinkorswim designed by people just like John Person. They're all based around pivot points. So this PPS and PMC, all 3 of these are tied together. The person's pivots, as I mentioned last week, are a floor pivot, that's the purple line, and an R1, R2, R3, S1, S2, S3. That didn't change. The formula is the same. The only difference is this thing will choose which direction it thinks we're going to go. If it thinks the market's bearish, then it gives you your bearish target and a line in the sand that price shouldn't get above. Call that resistance, call it support. Depends on how you like to do your analysis. It's still the line in the sand we shouldn't cross. But if it thought that this was a bullish market, it would be the other way around. That green line would be much closer to the purple line, somewhere right around in here. And it would have an R3 target way up here somewhere. Now, that concept of what it's doing, this automated process, is built on how we use floor pivots. So if you don't have John Person's pivot, you can just use a regular floor pivot. On Thinkorswim, it's called an SVE. I don't know why. That's just what they call it. But that's the floor pivot. I've checked the math on it. I know it's the floor pivot. And it's all the lines. So none of them are turned off. You would just use it the same way. It's got the R value, and then it's got your S values. If you're bearish, price should not get higher than the first R value, but a lot of times it will run up to that first, kind of get that head start before it makes its trip, which, looking at it another way, a lot of times we come down and we hit support and we rally up into the R1 and then roll over and go down to the next level, S2 or S3. It'll be down here. And we see that, all the time. So is it perfect? No. I mean, nothing is. But even on this choppy, sideways, nasty day, what do? Ran up and hit the R1 and then made a S2 trip. So the person's indicator tries to determine if we're bearish or bullish and then turns on and off the red and the green lines for you. But if you don't hear, and the darn thing isn't present anyways, it's not smart, right? It's just looking at the math. You can just turn on a regular floor pivot and do it all for yourself. Okay. So don't get hung up on it if you're on a trading platform that doesn't have person's pivots. You can do it with just regular floor pivots in R1, R2, S1, S2. No worries. It's not the same with Camarilla pivots, by the way. Camarilla uses an entirely different system, but this isn't pivot class, so it doesn't matter. 10-day, 30-minute volume profile. We are building a little closer to the classic B. Not quite there yet, still a long ways away from the point of control, but we're looking to see this come down as the week wears on. Mainly that it's going to break. We're going to lose all of this volume, and that means this long Schwab where the point of control is on the TPO is going to be gone. Then we'll start taking out this structure here, which will eliminate the point of control. It's very likely it'll drop down to 50.90 unless we stay in a really tight zone here and build up a lot of volume today or tomorrow, which it's absolutely possible. But we're talking about an entire week worth of volume needs to be taken out. And in a week, we could already have broke structure, had a TRB, and we could be sitting up at 5,200 for all we know next week, or legged down into 48. So if we hold this line, we could anticipate building out the point of control here, but otherwise, I wouldn't expect to see any assistance or any help out of this point of control anytime soon. 10-day, 30-minute volume profile is useful until it isn't, right? And if we're going to turn around and go back up, what we've already got laid out will really help us out. But if we continue to leg lower, it's behind us, right? It's just not useful if we continue driving in this one direction down, because we're leaving behind everything that we're building on that 10-day, 30-minute. The 5x5 here offers us a VPOC this morning. It's from Friday. So if we do break to the downside, it's just above the 5,000 mark. See if we can get this a little closer. That'll do. So VPOC 5003. But really, if we're that close to 5,000, I would expect to get to 5,000. Keep in mind, liquidity resides on the other side of the pivot, no matter what that pivot happens to be. So if the pivot is 5,000, liquidity is on the other side, and they can front run it, hitting this 5003. It's obviously what they did Friday. It's why it was the point of control. So they can front run 5,000, or they can be on the other side of 5,000, but I wouldn't expect them to be right at 5,000. Right now we're at the COG line, 5031, and it's very likely that liquidity is on the other side, right? On either side, same scenario. It'll be below it or it'll be above it, but it wouldn't be right at that spot. Really not much more to say about this. The profile on the 5 really isn't offering us any hints on icebergs or ceilings this morning in connection with TPO. So we looked at the size of the box last week, the projections of what this week could be. We can see that there is more volatility priced into this week's market than there was for last week's market. The range this week is bigger. That range is derived by volatility. this implies that there is more volatility this week than there was last week. There's an anticipation of violence, of bigger moves this week. It's not FOMC, it's not QRA, but we've got Europe today and PMI tomorrow. And I'm hoping for a reasonably decent afternoon of trading, especially since, you know, the data tomorrow is going to be after the 9:30 open, that it's far enough away that we can actually just get a good afternoon done and then go into a hurry up and wait mode between the overnight and into tomorrow. That's the hope. But the fear is with that after we're done with Europe at 11:30, we just settle in sideways for the rest of the day into overnight all the way to tomorrow with CPI, PMI. And if that's the case, it's going to be a very boring, sideways, choppy, nasty mess. So right now we're just a little shy of 1.5% below the 10-day. Trying to work our way back up. We were more than 2% below the 10-day moving average. So reflexively, we're moving back towards it. Just to kind of get a feel for how different the market is right now. Our blue line is below the zero line, and that hasn't happened since November last year. So we're in a changing market dynamic, and it's not another bear market signal or anything like that. We got enough of those out there already. We are reflexively moving back towards the 10-day. Just like previous times when we look at price when it was below the 10-day, we can see where it doesn't make the trip back in one shot. It can start pulling back to zero and then fall away again and come back a little closer and fall away again. It's not a linear path always, right? So sometimes we just come right back up and right through all in one clean shot. And then other times it's a bit of a journey. So this idea that, you know, we're headed back all the way back to the 10, not with everything else that we've got to deal with, and especially with earnings and econ on deck this week. We're almost the same distance from the 10-week as we are the 10-day. Interestingly enough. Now we've got the anchored VWAP over our head as well, since we cut through it last week. We are working our way back towards the zero line, but just like when we were looking at the 10-day, the 10-week, it's not always a straight shot back up there. It's just going to take time. This market got damaged pretty bad. And whether or not the Magnificent Seven can carry all of the entire market like it did the last time, I mean, that's debatable anyways. Apple's got, you know, some weakness of its own. Tesla's got issues, right? You kind of go down the list. They're not as strong as they were. And then you got companies like Netflix and what it did last week. That was a self-inflicted wound. How much worse is it going to get? If we don't have the Mag 7 to carry us and the rest of the market can't carry us, then I think 48 is not out of line. But just watch the 50-day or the 55-day on a lot of those names, that we got a lot of the market balanced right on that 50. So that's the air pocket or the flash crash setup. Not in the S&P, obviously. We're already way below it, but for the week, this range is a little bit bigger but not massively so. It's not like a big surprise, massive size difference, just a little bit. Over the last 5 days, jets are up 5.5%. Nat gas is up more than 2.5%. Regional banks are still up 2%. And that's a 5-day time frame. Things that are down, semiconductors are down more than 8% over the last 5 days. The bond index, bond volatility index called the MOVE index, is down significantly. Might be worth taking another look at bonds. The MAG 7 collectively, with the little homemade ETF that we use, is down 7% over the last 5 weeks or 5 days. Tech, biotech, semiconductors again. So you can see there's a number of big moves in things that normally wouldn't be so negative, like semiconductors and the MAG 7. So it's not a surprise that we're as beat down as we are. Looking at what's down today, gold miners, they're both down. The VIX is down. It's a little odd. Bonds. And that's it after bonds. Things that are up. Bitcoin, more Bitcoin, China ADRs. Baba, Baidu, JD, all that group. Semiconductors are up. Even the double and triple leveraged semiconductors are up. Biotech, nat gas, and financials. Not KRE specifically, but financials, it's a good start. A lot of the insurance names got whacked last week. So, maybe we're seeing a little bit of rebound in those. US dollar Japan is also up. It's threatening this 155. Don't know what it's going to look like for US dollar Japan to break 155 and leg even higher to the upside. But we can see the Dixie, the dollar index, threatening this inside day breakout. We're still inside of Friday's zone. And that's what we're going to be watching for, an inside day breakout in the dollar. And we're already inside day breakout on the 10-year. Now, once the market's open, you can swap / 10-year for something like TNX. Gold is down. We would expect maybe the NASDAQ to give us a little to the upside with gold down. There was analysts saying that one of the tells for the NASDAQ rolling over, 6 weeks ago, whatever, was that gold was, taking off like a rocket ship. And now we've got gold to the downside. Where's the reciprocation? If gold going up was holding the NASDAQ back, where's gold going down, lifting the NASDAQ up? Maybe expecting it to lift it up is out of reach. We could look at it as if gold is going down, it's no longer pushing the NASDAQ down. It may not lift it up, but it won't hold it back if it was to go up. I think maybe that's a better way to look at it, right? The NASDAQ also closer to the upper ADR than the lower ADR, but it is underneath the 3-day moving average. And even if we get above it, if it can't keep it, it's a really nice short. So whether it's the S&P or the NASDAQ, getting above the 3 and then not being able to keep it usually sets us up for a really nice short. There's different moving average combinations that you can use, right? People use things like 8-10 or the 10-20, 20-50, 50-200. Using a pair is usually it's a common theme. A 3-8 is surge. So you get price crossing the 3 and then 3 crossing the 8. That's a surge setup, whether it's down or up, right? So it's just a nice continuation play. S&P and the NASDAQ both are holding VWAP. We're just reciprocating back and forth like a jigsaw, reciprocating saw until we don't, right? So if you're looking for a play, you can just measure this zone and look for it to finally expand. Now, my VWAP reset itself at midnight. If you're using one that started at 6 o'clock last night, then you don't have this interference, where mine started right there. You would have a bigger range to measure. But it's not that much more extreme anyways. You would do that with your quant lines. Look for it to break this zone. That's our reciprocation level right now. I like it a little tighter. I would focus on just this nearest term, distance below, distance above. Look for reciprocation to end. At least it's a two-sided market. There's one group trading into another group. One is unloading a position of considerable size and the other one is picking it up. If everybody was all going in the same direction, we wouldn't have this balance, right? So a little bit of Captain Obvious, but look for the balance to break. Keep your eye on the dollar and the 10-year. If we get the 10-year back inside of Friday's range, it needs to keep it. A nice, slow, gentle move to the downside, aiming for this 10-day moving average would be nice. No fast moves, nothing sudden, nothing extreme. And same thing with the Dixie. Failing to get that inside day breakout is a really good start. Working our way back down to at least where it opened last night, and then through our own low from Globex, and then the low of yesterday. Nice, subtle, soft moves to the downside. No sudden movements in either one of those two. And for US dollar Japan, it's the same thing. We don't want this breakout. We don't want new highs, but we really don't want to see a flash crash here either. So subtle moves to the downside. None of this stuff. There's multiple times last week where everything was down and everything was up. So we'd have a falling dollar, falling NASDAQ, falling S&P, falling 10-year, falling gold, falling US dollar Japan. Everything would fall and or everything would rally. So, that's usually an indication that we're transitioning out of one theme and into another. And it wasn't just down. We were seeing those same moves on reflexive pushes in the other direction. So up on all of them, down on all of them. And it's not supposed to be that way, right? It's not like it's a teeter-totter where one goes down, the other has to go up. Just generally, if one is weak, then the other is strong, or vice versa. So things are broke and we need to get past it, get on the other side of it. So it's not just some reflexive play where you see the dollar falling and you immediately want to go long in the ES or the NASDAQ. Don't do that, because, I mean, look, we're falling right now in the dollar, and this isn't popping to the upside with strength trying to rally. So you can use swag lines or something instead, right? And if I was going to swag it, I would say we need the dollar back below 106 as a really good start. We need the 10-year back below 4.6 as a really good start. And US dollar Japan, it needs to stay below 105.5 and, kind of get back down closer to well, not 105, 154.5. And it would be better if we were back below 154.25. Watch the news. Keep your eye on the clock. Let's see what's happening with the pot stocks real quick and wrap this thing up. Why did it log me out? Doesn't matter. Bitcoin, China, solar, nat gas, technology, China again, and then China again, and then the XLF financials. And IWM bringing up the rear. A little bit of violence there. Some dark pool prints likely. It tried an inside day breakout and failed. I'd like to see that try that again. All of these markets, whether it's the S&P, NASDAQ, Russell, they all have a lot of resistance overhead, a lot of damage done. It needs to, it's going to take a lot of time to come back out of this. So it's not going to be a straight shot. If we're looking for a rally day, the fact that we have tech up and we had some semis, there they are. We've got semis up. It's a good start. We want to see that expand more. Pot stocks are up a little. They're not going to help that much anyways. And then Bitcoin ties in with semiconductors. So with the Bitcoin plays, Hut, Hive, Mara, Riot, Coin, MSTR, BITO, plenty of names to play in that space. So we got a pretty decent basket this morning. Simi's got a beat down Friday, bad. So a lot of that semi play could just be a reflexive bounce up. And we want to see if that's going to stick or if it's really like a dead cat pounce, it's just going to roll over and take out the next zone. Everybody be careful, be safe. I'll see y'all tomorrow.